A key part of being a skilled investor is knowing how to properly analyze a stock. Base counting is an often underrated but very important chart assessment tool. As you may know, a base, such as a cup with handle, double bottom, or flat base, will form and give a stock a level to break out from. Once the stock breaks out and travels higher, it may go on to form a second or third base on top of the first one. But if a stock undercuts the lows of a previous base, the base count starts over again at 1. So, why is this important? Most leading stocks can typically run through 2, 3, or even 4 stages of bases before losing steam and requiring a more serious consolidation. It's important to have a clear picture of where a stock is in its life cycle to truly understand what it is you're trading. As with all chart analysis tools, the key to using it well is in the nuance. With IBD's Market Surge charting tool, you'll see a number next to the word stage when hovering over a base. Here to help explain how to use this is IBD's Mike Webster.
So the first number is the number of stages that you have. And the second number is the number of bases you have during that stage count. And what can happen is you can have it be different if you have a base on base, which is not another stage. And the easiest way to think of it is look at the last base. That should what are we there? So that was a first stage base. And why was that a first stage base? Because it undercut the low of the little flat base to the left of it. So that resets its base count. So hover over the little flat base to the left of it. So you'll see that that was a 4 and 4. So there was 4 bases in there without any base on bases. If there had been base on bases, that in parentheses would have been 5 or 6 or 8 or 10, because that just counts the number of bases. Because if you break out from a base, like so this last base, go to the right of it, that first stage base, if it had broken out and only gone up 19.9% or 1% or anything in between, 0.1%, then informed a new base, that would have been another count in there, but it wouldn't have been another stage because it didn't run up a full 20%. You can clearly see that this most recent base was another 20, was at least 20%. It was a lot more than 20%. And so that was another stage. And so that's why we have that count in there. It'll say like a 1A, 1B, 1C. That means those are all first stage bases within a base on base family.
A good example of this would be looking at Spotify's chart. From August 2022 through February of 2023, the stock formed a first stage base, which clearly undercut the low of the prior base from February 2021. Later, in July of 2023, the stock formed yet another base after a 20% increase. This makes it a stage 2 base. But then the next base formed before the stock moved up 20%. It was a base on base pattern. Therefore, these two bases are designated as stage 2A and 2B instead of a new stage. But the base count, which is in parentheses, moved up to 3.